Welcome to What School Should Have Taught You. This is a podcast where you learn all the lessons about wealth creation and we get to answer your questions as well. Click the link below and send us your questions so we can have a chat to see if we can give you some assistance moving forward in the future. I'm really looking forward to this next person. Matt is a business owner. He's had a good structure that he's set up around it, and he's really wanting to see how he can maximize the amount of money that he's earning while also minimizing the amount of tax that he pays, all while enjoying a very strong borrowing capacity moving forward in the future so he can continue to invest. Really looking forward to talk to Matt coming up soon.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy.iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
G'day, Matt. You're Jeremy.iannuzzelli. How are we going today?
Pretty good, mate. How are you?
Mate, very well. Thank you very much for calling into the show. Haven't had a real good chance to review your question today, but I'm really looking forward and excited to hear what you want to ask, and hopefully we can give you some really good guidance moving forward and get you on your path that you need to be to create a bit of wealth. But Matt, if you would like to share with us and the listeners your question.
Yeah, so essentially I've got a small business that's kind of at that point where it's transitioning from having enough money to like work for yourself business to actually making a bit more profit at the end of the day. And my question was really around what's the best way to kind of structure that to pay myself a bit more or to use that money for my future without just, paying myself heaps of income and then paying a lot of income tax as well.
Agree, mate. And it's one of the plights of running a small business. We work so hard and we sacrifice so much at the very start, and then all of a sudden we start to make some money and we feel like there's a substantial amount of money that walks out the door to the tax office. So structuring is key, mate, and it's getting the right things in place now so that ultimately moving forward you can have the most amount of money to do the best things that you possibly want to do. Now, I want to ask a couple little questions. Your small business, how are you structured at the moment? Are you a sole trader or are you running through a company, Matt?
I'm a company that is owned by a trust.
Beautiful. So you've actually got a very good structure. So your shareholder at the moment is a trust. You're a PTY Ltd, which is running the operation. What that gives you, and you've done very well to get the foundations right, because what it gives you is a great opportunity of being able to move that money around in the future. Now, at present, you're paying yourself a wage from the small business?
Yes. So I'm paying myself a wage as an employee. So I'm not taking dividends or anything.
Lovely. And you're married or de facto? You got a partner, Matt?
I've got a wife that also works for the business.
Lovely. Fantastic. Now, what that does is that gives you opportunities to be able to commercially pay both yourself and your wife at a rate which is quite consistent with the company tax rate. Now, I'm assuming that you're a small business with less than $50 million turnover, Matt. Is that correct?
Just under 50.
Good. Love it. Love it. Now, what that does...
You hear the joke in my voice.
What that does give you, mate, is it gives you an opportunity where your tax rate from a profit perspective in the company is only 25 cents in the dollar, which puts you, puts the company in a position where it's paying not absolutely, it is paying less tax than what someone who's earning 45 grand is doing. So it's a great opportunity for you to build up retained earnings in the business with only a 25% tax rate, giving a bit more capital for your ability to grow the business in the future. Now, the perfect situation is, as an accountant, we really love to try to bring up the employees, which are the owners of the business in this particular case, yourself and your wife, commercially, up to around about $120,000 plus super. Now, the reason why we like to do that, Matt, is it is close as we can get to the tax rate of the company. The tax rate of the company is 25 cents. And when you start to earn over 45 grand, your tax rate's roughly in that 30% bracket. So it's only really costing you roughly around about 5 to 6 cents in the dollar on top of the 25 cents that the company would have been paying on that profit if it was left in there. So if we can get you in a position where you and your wife commercially are being paid about $120,000 plus super, that's really good. It's a great way to take some money out of the company for you to pay down maybe your debt on your own home, you to take the family away on a holiday, or just to have some free-flowing money for other investments. You've also got the opportunity, Matt. Now, I won't give your age away, but what's your age bracket? Are you between 35 and 40, Matt, at the moment?
Yeah, yeah.
Beautiful. So
In there.
in there, lovely. So it's not that you're too old, but you're not 22 either, mate. So it's not that
Yep.
we're counting down the days to retirement. You've still got a full life to live, but nevertheless, the planning starts now. Are you at the moment giving the maximum contributions for yourself and your wife into superannuation, Matt?
I'm not.
No. So there's a really good opportunity there. Now, there's some rules in place called the 5-year carried forward rule. And the 5-year carried forward rule means you can go back and top up your superannuation balances for the prior 5 years. So if you haven't reached the cap, which is about 27,500, it's a great opportunity for you to go back and top up your super if there is enough free flowing cash in the business to do so, or in your personal name. You've also got the opportunity to contribute up to the maximum superannuation threshold limit, which is 27.5 grand. Now, what that does give you is, rather than you paying yourself more money on top of the $120,000 salary, which then takes you into the 40% tax bracket, you've got the opportunity of doing what they call a reportable employer additional contribution. So that is that the business is paying a bit more superannuation to you and your spouse, essentially meaning that the business gets a 25% tax deduction on that. Only 15% is paid in super. Or otherwise, if that money was to go in your name, you'd be paying tax at 40% and the super fund's paying tax at only 15%. So there's roughly about a 25% benefit in doing that. So that's a great way to also take a bit more money out of the company for you, Matt, and essentially bolster up and build up your wealth so that, yes, with your super, you can do things with it, like maybe potentially buy property or invest in shares if you wish to, or other collectibles in a self-managed super fund. Or you can leave it in industry or retail funds and it can continue to grow. So there are a couple of options for you as well. What you do have, and what I am encouraging all people as well, Matt, is the stage 3 tax cuts. Now, has anyone explained to you what that is yet, Matt, the stage 3 tax cuts?
No, that's new.
All right, mate. What it does do is not levels the playing field, but it gives middle income and high income earners a substantial benefit. Stage 3 tax cuts come in from 1st of July 2024. And what that means is someone who's earning $45,000 is now paying the same tax rate as someone who's earning $200,000, which is a huge win. So roughly it's about 31.5 cents in the dollar, including Medicare levy, roughly. So what that's giving people an opportunity of doing is it's giving people an opportunity of taking out additional funds from their businesses without getting whacked with a 40% tax outcome. So that's a great opportunity for both yourself and your wife to be able to take out a little bit of extra money from the business. Now, you've got a trust which owns the shares. I think that you mentioned that early on. Is that correct?
Yes.
Mate, you have done exceptionally well with the structuring of your business, and what that will give you as an opportunity is you'll be able to declare dividends. Have you declared a dividend yet in your company, Matt?
So that was kind of what I was interested in. So the difference between dividends and taking it as a wage and everything is something I'm not cluey on.
Lovely, mate. Thank you for asking that question, because a lot of people have that same question as well. So when you take a wage, that means you'll be paying tax at 30% or 31%, depending on Medicare. You'll also have to mandatorily pay yourself superannuation as well. And also on top of that, in most states, you'll also have a workers' compensation payment that needs to be paid, because on all the wages, we pay workers' comp on that. Workers' comp can be quite expensive depending on the industry that you're in. But a dividend is exempt from that. As long as you're paying yourself a commercial wage, a dividend is exempt from superannuation, and a dividend is exempt from workers' compensation as well. Now, the franking credit system is a very unique system, Matt. What it allows us to do is any tax that the business has paid already, when we declare a dividend, that tax, franking credit the business has paid, comes with that dividend as well. So essentially what that means is you've only got a little bit of top-up tax that you need to pay, which is your marginal tax rate, less the tax rate of the company, which is 25 cents. So there's roughly going to be about a 5 to 6% top-up tax. So if you've built up enough franking credits in your company, you've got the opportunity to be able to declare that dividend to your trust, Matt, and then that trust will have the ability to discretionally distribute that profit to yourself and your wife, or potentially any other beneficiaries as part of your deed, and there would only be potentially a little bit of top-up tax. But if you have beneficiaries who are very close to you and you need to pass through that money to them. That's the rules. But if you've got beneficiaries that are very close to you and there's a way that they can benefit as well from these particular dividends, or your kids are above the age of 18, you've got the opportunity to distribute that dividend with the attached franking credit to it and potentially pay no top-up tax for the beneficiary who's receiving the distribution, or you might have to pay only a slight amount of top-up tax depending on what your income is as well. So you've got a very good outcome there that potentially can come from the ability of declaring a dividend to minimize, yes, the potential of having to pay superannuation if you don't wish to. Also, you've got the opportunity to minimize the workers' compensation payment on the wages and save a truckload of tax along the way. So in your particular situation, Matt, you've got a great opportunity, yes, to pump up the wages to both yourself and your wife, which is going to give you ample opportunity of having more money. You've also got the opportunity of contributing to superannuation as well, which is going to help bolster up your retirement funds and give you much more opportunity to invest that money the way you want to. And more importantly, what you've done well is the way that you've structured your business, Matt. You've got opportunity of really declaring dividends to the trust, and then that trust being able to discretionally distribute the profit the way it wants to. So you've actually got a really good structure at play. It's just a matter of now of executing on all those various different opportunities. Matt, are there other things, that you would like to touch base on? Are there any other questions that you might have that, we need to elaborate on a little bit more?
I just had a follow-up question on the dividends. So you have to be getting a wage. You can't just take dividends. Am I hearing that correctly?
Yeah. So what workers' comp and the tax office really like to see is they like to see people being paid commercially. Because we flirt with this line called Part 4A, which is tax avoidance. And we flirt with this line of good tax minimization or good tax planning. So the reality is that if you are working in a business, let's say, for instance, now this business is not your business, it's my business. If you are working for me, you would want to be paid a commercial wage in return for your time. And that's the way the tax office sees paying wages, and that's the way the workers' comp officer sees paying wages as well. So you must be remunerating yourself commercially. Once you've remunerated yourself commercially, then we can start to really have effective tax planning that comes from that. Now, I suppose the best way to say it is commercial wages doesn't necessarily have to be $120,000. In your industry, if a commercial wage is $80,000, then that's your commercial wage. And then, yes, you can definitely top that up with additional dividends that you get from your trust, who is the shareholder of your company. And again, that could be a great way to minimize potentially the amount of super that you mandatorily have to pay and the amount of salaries and wage tax that you need to pay through your business activity statements, which is essentially giving the money to the tax office in advance as opposed to giving that to them at the end of the financial year, which could alleviate some pressures from a cash flow perspective as well for you. But generally speaking, commercial wages for business owners does sit probably that topper end, close to 120,000, but not necessarily all the time. So I think what you need to do is between you and your wife, you need to identify what a commercial wage is in your industry. And then that opportunity of being able to top up the amount of income through dividends by way of a declaration to your trust and then from your trust to you is a great way to really absorb some of those franking credits, which is the tax that the company's already paid. And then from there, you're really able to then really push that money around to get the most advantageous position, I should say, from a tax perspective. Have you got kids, Matt?
I've got a few, yes.
Lovely, mate. They will definitely pay themselves back in the future if you're still running this business when they do turn 18. So hang in there. Don't throw them to the lions yet, mate. I know with my little one at home, he's definitely hard work, but don't throw them to the lions yet, because they will provide some advantageous opportunities, especially for minimizing tax in the future. But also to keep in mind, don't fall into the small business mindset as well, Matt. Your goal in business is to earn as much money as you can. Don't get stuck in paying for cars because we need to minimize tax, or paying for outrageous expenses because we want to quarantine or minimize the amount of tax that we pay. Your goal needs to be, how can I earn as much money in the business that I can? Because at worst case scenario, again, for small businesses, no matter how much profit you make, your tax rate will only be 25 cents in the dollar. And that's sometimes less tax than someone working part-time at McDonald's, for instance. So your goal needs to be how you can earn as much money as you can. And then with those retained profits over time, there might be very strategic windows of opportunity to get that money out of the company, or to, declare dividends, or to be able to potentially extra or additionally contribute into super. So I'm a big fan of kind of holding your chips close, looking for various opportunities when they open up, and then executing on those opportunities. And when you do execute, you've got enough capital to do so, and you've got a substantial opportunity through the structure that you created to get the most out of, or the most juice out of that orange, and that orange being your business today. Matt, on that end, is there anything else that we potentially can, or is there anything else that you would like to elaborate any further, mate? Because your question is a fantastic question, and probably does impact probably 90 to 95% of small business owners out there. And small business owners, they are the blood and the heart of the Australian economy. So we do want to make sure that majority of the money that you guys are earning is going to your own back pocket, and also the ability for you to grow your wealth and to provide for yourself and your family well into the future.
No, I think that answered my question. Yeah, so I think the part about like falling into the trap of like buying expensive things to not pay tax in inverted commas was poignant.
Yeah, beautiful.
I think that is like, because that's definitely something you see a lot. Like there's an undercurrent of like, go buy that car, go buy this thing. Like, it's an expense. But if you don't need the car, then it's a wasted expense.
Absolutely. Because remember, that dollar that you spend, it's only saving you 25 cents in tax. So 75 cents of your hard-earned income, it's going into someone else's back pocket. And you know, if they're flowing and contributing as well, but the chances are they're probably putting that into a very good investment, and you're aiding and helping their retirement. So really only spend the money that you need to spend to grow your business and sustain your business, and focus on how you can invest a large portion of your money depending on windows of opportunity that may open with inside the business or your own specific situation, and take advantage of them. And mate, that's where you're going to grow. That's where you're going to grow personally, and hopefully, mate, your business will grow substantially more. And I think the next question is, Jeremy, I've got way too much money to play with now. Where's my next investment opportunities? That's the conversations I love to have post these ones, mate.
That's a good problem to have.
It is a good problem to have.
I did have one additional follow-up question. In terms of like the other tricky thing as a small business owner is getting a home loan, getting money from the bank. How will bank, like, what's a favorable structure for there? If I'm paying, half in dividends and half in a wage, is that seen more poorly than if I was to take all the money as a wage? Or like, what's the move there?
Yeah, this is the struggle that I see with all small business owners. It's that dance around profit, saving tax, but then also obviously trying to obtain loans as well. Different banks have different policies. Typically speaking, some banks will only look at your salary credits, and they'll base the borrowing capacity just purely based on the amount of salary that you pay yourself. Now, unfortunately, the negative of that is that, yes, if you do pay yourself a substantially large wage, you will be paying a lot of tax on that basis. Most banks will look at a combination of the profit that your business makes and the wage that you pay yourself. So if your business has made, for instance, $80,000 in that financial year as a profit, and you've also paid yourself an $80,000 wage, they'll actually combine those together and say, well, Matt, your income was $160,000 because you've got access to that $80,000 at any particular time. It's just that you've chose to retain that inside the company. Now with dividends, it's important to understand that dividends is a payment of retained profits. Now sometimes it could be the profits of that year if you've paid enough tax towards building up the franking credit balance. But in most cases, dividends is a payment of retained profits from the prior year. As long as those dividends are going to you and not someone else, then the banks will take into account that, yes, those dividends are going to you, so therefore the profit that the business is making, it's really all applicable to you as well. So we're going to take the MAT group into consideration when conducting your borrowing capacity. It's when you start to send those dividends to external people in the family, for instance, like mum and dad, the banks can choose to say, well, we're not going to take the profit that the business makes to you because the money's not going to you. The money's going to your mother, for instance. So you need to
Yeah.
be very selective, and you need to really open up. And again, we spoke about windows of opportunity before. If there is a window of opportunity for you to have that dance with the banks and be able to borrow as much money as you can to build your wealth, you need to make sure that you're speaking with your professionals, your mortgage broker and your accountant, so that they can really make sure that they're telling the story the right way to get the banks to say yes. So you don't necessarily need to pay yourself a stupid amount of wages and then have to pay a stupid amount of tax on it. You can choose to leave some of that money with inside the business and build up the profit. Yes, paying tax at a much lesser rate, a fixed rate of 25%, and then presenting your financials to the bank with, hey, this is the profit the business is making, and this is the wages that I'm earning. This is collectively my income that I want to show you as being the bank that I can use to borrow and buy property. There are some other things that come into play, Matt, as well, like any borrowings that you've potentially got through the company. Most small businesses don't have a lot of borrowings, potentially outside a car loan or maybe some equipment loan. But again, if you can get that picture right between you and the broker and the accountant and really put your position forward to the banks, which is healthy, and again, by leaving some money in the business as a retained profit, that's going to give you the best opportunity of getting benefit of both worlds, which is A, minimizing the tax that you need to pay, while B, maximizing the income that you're showing the banks. So I hope that's given you a little bit of clarity, mate, because it is a dance, and I think sometimes if you can lead that tango with the banks, then mate, you're in the best position that you possibly can be.
Awesome, mate. Thank you. I appreciate that.
Mate, really appreciate it. There's a lot there that we've gone through, and I really appreciate your question coming into the show, because that is a 80 to 95% scenario for many small business owners. I'd love to say, mate, that you've structured things the right way, and if you can get the way that you move those payments around through to yourself and your wife on a commercial basis, and then topping that up through dividends from your company to the trust, that's going to put your family, the Matt Group, into a really good position and essentially put you into a much better position if you can start to match that with some really good investments on the other side. Don't forget the super, Matt. Super's key. It's going to give you a really good outcome for the future and a really good tax saving benefit as well. And hopefully, mate, we've been able to answer all the questions around you obtaining the most amount of benefit while maximizing the tax deduction or minimizing the tax that you need to pay to get where you need to be.
Thank you very much, mate.
Appreciate it, mate. Thank you. And looking forward to hopefully seeing how you go moving forward in the future. And would love you to come back on the show, mate, and just let us know some of the outcomes from any of the strategies you've chosen. So thank you very much, Matt.
Awesome, mate. All the best.
It was a really interesting chat to talk with Matt, a business owner from South Australia, working his backside off and doing very well. And excited to see that he had the right structure. And he mentioned that some good friends gave him some assistance with that right structure, but his business is operating in the right manner. It's got a good structure, being the shareholder of a trust, and it's going to give him many opportunities in the future to be able to really maintain a high level of income in a very tax incentivized way. Matt is looking to build up the amount of income that he takes, and we can do that, as we spoke, through the ability of creating some commercial salaries for him and his wife who are running the business together, and the ability to distribute the dividends from the company to the trust and from the trust to the beneficiaries. It was good to see that while he's earning extra income, we've taken away the notion that he needs to pay himself a ridiculous amount of wage to do it. There are some mainstream lenders and banks out there that will take into account business profits in a more tax incentivized space at 25 cents in the dollar on profit, as opposed to a much higher tax rate, which could be well into the 40% range. So it's good to see Matt will start to initiate some of those strategies, give him an opportunity to continue to grow his business in a tax incentivized way, more capital that he can take out for investments moving forward in the future. So I hope, Matt, we've answered your questions and given you a really good leg up to maximize the amount of income that you can take while minimizing the amount of tax that you pay through some of the good structures that you set up. It's just now honing and refining the way that you derive your income, and also making sure that the good professionals around you understand that your path that you're on and you can execute it to the best of your ability. Click the link below and send in your questions. I want to get you on the show and chat about all your concerns and how we might be able to give you some really good insights of what to do next. This is what school should have taught you. I'm Jeremy.iannuzzelli, and I look forward to chatting with you next week.